After this recent correction and subsequent market bounce back, there are probably a ton of traders out there who are suffering FOMO, the fear of missing out. And that fear of missing out was realized with some of these big moves. Because you did miss out on some large pops in stocks like Apple, Baidu, Facebook, which is now Meta Platforms, and Walmart. So a lot of traders are going to go back over these instruments to find out what they missed. Right? They're going to try to figure out what could have alerted them that a trade was near. Let me take the pressure off you, because the truth is, you do not need to catch those moves. In fact, as one trader I know put it, you are not responsible to catch that move. How can you? Because there are a lot of times that big moves are going to come out of nowhere. It might be news-driven, the words of a politician, or any number of reasons that can happen. And regardless of why that move happens, it is unreasonable to pressure yourself with that feeling that you should have known it was coming. Because there are a lot of things in trading that we don't know. Right? We play the odds through an edge that we may have over a basket of trades. Right? When we do that, we do well. If you look at this chart of Airbnb, that is 11% jump in price in one day. And as you flip through your charts, you probably see this move, you draw a few lines and assume that you could have caught it. But I can say this about that chart. It broke an upsloping trend line. Price came into an area that acted as support. And when that happens, you expect a retest of the underside of the trend line. And that is so easy to say right now because I'm looking at the chart and that's how it happened. But if this move up never happened, I would probably just ignore price sitting at support. And I'd ignore the chart. Now, even if this was a ticker that I usually trade, I may still have missed this trade because it's not like there's much to see in that price that gave me a heads up in terms of how I approach the markets. Keep going with this chart here. It's a strong move up. And any further move up now, that is the one that I am responsible for. Because I know that when price puts in a strong move to the upside or the downside, my job is to find a pullback, but not just any pullback. I have to see low momentum in that pullback to consider another leg up. So using any one of my trade entry techniques, I can find a way into what I consider this to be, which is a bull flag. And if this stock is on my list, I can forgive myself for missing that first move because that first move, it's not my concern. This next move, well, that one's on me because it's setting up. This is a gap down in PayPal. And if you look at that circle consolidation, there are a lot of you that think that you probably should have just positioned inside of that. You know, the whole, well, if only I placed a trade during that pause. And yeah, you can absolutely position inside of ranges before they break. But would you be saying that exact same thing if price just remained in that range and didn't gap down? No, you wouldn't. Because you're not responsible for that move, right? You're not responsible to be in that move. But that next leg down is a good setup for a bear flag. We have strong momentum to the downside, right? The gap makes that clear. The rally, there's not a whole lot of momentum in that. The gap down alerted you to a change in market state. That low momentum pullback alerted you that buyers are not strongly stepping in and those short aren't unloading. That is a higher probability trade to the downside, and that's what happened. This is a 19% pop in Oracle. In fairness, this was an earnings jump. But these types of moves, they happen without any sort of fundamental news as well. And if you had a simple call option on this ticker, you did really well on this day. Now, some traders will be on alert for a gap fill play because they didn't trade the gap up. There are traders that's what they play. They play the fill. So now they are responsible to catch any move down. And just like that PayPal move, it's really easy to say that you just bought in that consolidation. Honestly, my own method of trading gave me zero indication of a potential move in Oracle. Okay, I don't say, look, I missed that move. How much I could have made. I don't say that because I didn't miss it, because I wasn't even looking for it. This is ES futures. Now this push into resistance, it's not something I'm upset about because I didn't catch it. But what is setting up now? Now this is my responsibility, because that strong move up and a consolidation near highs gives an edge to an upside breakout. So if I was trading ES, my responsibility is now to get in that next move. So with a long bias, any breakdown below or strong momentum to the downside, well, that would have me rethinking that breakout of highs. But the move out of here to the upside, that's my concern. I don't care that I missed that first move. And one of the best ways to avoid that destructive process of always beating yourself up for missing a move is to know your setups. This is forward daily chart. And one trade I look for is called a failure test. And that is when price will probe the highs or the lows and get rejected. So Ford was in a consolidation at the highest high since 2001. 20 years. So number one, price dips below support of the range and is bought up. That is a trade entry that can either be used to trade a range or position before a breakout. At number two, price broke out of the range with momentum. So unless you have a setup that gets you in before the break, you did not take part in the move up. But that's not something you missed. Okay, it wasn't on the radar because that's not how you trade. But if your style of trading a breakout is the following, you're responsible. So if you allow the price to break out of the range, it did. Take a position during any consolidation outside the range. And until this happens, any large price move, you can't be concerned about because you didn't miss anything, because that's not how you trade. So if price breaks out and continues running, you still didn't miss it because you don't trade breakouts that way. But if price pulls back, consolidates, breaks to the upside, that is your job to catch it. And why is this important? And I'll tell you, because trading is tough. When you flip through charts and you see these big moves that you didn't trade, that is the worst type of review you can do. Large moves, they can come out of the blue, and it's not realistic to think that you can catch them all. You know, this whole I could have done this mentality can cause you to do some stupid things. Like jumping in and moving price because you think it's about to run, eventually that's going to hit you with some losses. The best advice that I ever got was to focus on a small group of instruments. And within that group, focus on a momentum or a mean reverting strategy, or both. And I favor both because I would rather be able to play both sides instead of just being biased in one direction. The fact is, you're not going to catch everything. But when you see a move in price that leads to your preferred setup, that is what you are responsible for. So what is the secret to catching every big move? Well, the secret is do it in hindsight, because that is the only place you're always going to catch them. I hope you like this video. I think it's a very important topic. Hit like, hit subscribe. Any questions or comments, pop them below. Good trading.